everyone, and welcome to our Bank of England Super Thursday preview with me, Craig Erlam, Senior Market Analyst at OANDA. We'll start by taking a look, at an overview of what we can expect. We'll then move on to some charts. We've got a few lined up, mainly focusing, of course, on sterling and the FTSE, given that these are going to be the most directly impacted, I guess, from what happens tomorrow. Firstly, what are we looking at tomorrow? Now, this is the economic calendar that can be found on the OANDA MarketPulse website. That's www.marketpulse.com. You click on this tab right here, and that'll take you to our economic calendar. And when you narrow it down with the filters, you'll get tomorrow's UK economic data, which is the PMI construction, the construction PMI, sorry, and the Bank of England announcement. Now, why it's called Super Thursdays? Because we get a collection of announcements. Firstly, you of course get the Bank of England decision on interest rates and asset purchase. That comes with the Bank of England minutes, and the quarterly inflation report, which, as the name would suggest, is released quarterly, and also a speech from Bank of England Governor Mark Carney in front of the press, delivering a speech and answering questions about the conclusions that the Bank of England has come to and their new expectations, if there are any. As you can see, these are mostly red events, which means a high volatility expected, which is why we're going to take a look at some charts as well. But in terms of what we can actually expect from the event, first and foremost, as you can see here, and that shouldn't come as a surprise to most, we're not expecting any change in interest rates. We are not expecting any changes to asset purchases. And both of these are expected to be unanimous. Really what we're looking at here is a case whereby the economy is now in a position, and Mark Carney actually touched on this at the previous event, the previous Super Thursday, where the balance, the upside and downside risks, I guess, to the economy were roughly balanced, and what that effectively means means is they're not really looking to implement any changes to monetary policy at this moment in time. If anything, actually, they did allude to the fact that the chances of a rate hike and rate cut are actually pretty similar at the moment, and I think there's a few factors really contributing to that. You've got the obvious factors, which is the fact that inflation has been picking up quite fast. Annual CPI currently at 1.6% in December. Now, you may say, well, that's still below the Bank of England's target rate, but it was 0.3% in May, just over 6 months before that, ahead of the Bank of England, ahead of the UK referendum, sorry. So a 1.3% jump in the CPI data, inflation data, is quite a considerable leap in such a short period of time. Now, of course, the rising commodity prices is going to be a factor in that, but I think the pound, the deflation, the pound depreciation is also a major factor as well. Core CPI up from 1.2% in May to 1.6 is also quite a considerable rise, particularly in the environment we do find ourselves in with inflation. PPI input prices went from being minus 4.3% on an annualized basis in May to 15.8% in December. That is quite clearly a big move, largely driven by the currency moves, but again, also, I'm sure the commodity prices and the combination of the two will be playing a factor in that as well. But with that in mind, if the PPI input prices are rising at such a rate, this is likely to filter through to inflation in the real economy, and that is likely to eat away at people's real incomes. And that is when I think the warnings are going to come from Mark Carney about that impact on consumer spending and therefore the overall economy, because the economy is driven by the consumer. So while the effects of the Brexit vote haven't been as severe as he expected and haven't come as quickly, I do expect Mark Carney to stand by his previous claims that the economy is going to deteriorate, and it's likely to happen over the course of this year. But the other side of that is the fact that, as I've just said, the economy actually has been far more resilient than a lot of people thought, and particularly Mark Carney, the Bank of England, thought when they gave these warnings back in May and June time. And we've already seen growth forecasts being revised higher, and the expectation is that we're going to see them revised higher again after another quarter of quite solid economic data. So you can see that everything seems relatively balanced at the moment, and I think that's why we're not expecting any rate cuts or rate increases, really probably prior to 2019 at this stage. I do think the risk is always going to be there because inflation is picking up faster than we were expecting, but the fact that the economy is more resilient is also going to be playing a role as well. But if the economy does deteriorate at a time when inflation is picking up, the Bank of England will want to avoid, if possible, raising interest rates into a struggling economy. And if they believe that the inflationary drivers are transitional or temporary, then they may be willing to look through them as they have in the past. As you'll remember, around the time that tuition fees were were increased, we saw inflation at over 5%. Bank of England actually looked through this because they believe that these effects were temporary, and they proved to be. Bank of England may be willing to also look through temporary overshoots in inflation if it believes that they are temporary, especially if the economy is in deterioration. So you must be wondering, well, what is the point of all this if everything's roughly balanced and we're not expecting any changes for 2 years, and you've got upside risks, downside risks, why were you expecting any change really at all in the charts? In this scenario? Well, the simple fact of the matter is, because you've got these upside risks, you've got these downside risks, what we quite often get around these events and around these announcements, and particularly throughout the press conference, is a lot of volatility, because Mark Carney is going to be grilled by the press about the outlook for the economy, about the outlook for growth, for inflation, what it means for their forecasts, and this quite often presents a lot of volatility for the markets, particularly the pound and the FTSE. The FTSE, of course, as we've seen since the Brexit vote, has been inversely correlated quite well with the pound, because around 75 to 85% of profits in the FTSE 100 are actually generated outside the UK. So the depreciation in the pound has actually been beneficial for earnings in sterling terms for those that have been made abroad. So if you've made the same amount of money in Germany as you did prior to the Brexit vote, well, the 20% depreciation in the pound since then means that the sterling value of your earnings made in Germany are actually 20% larger. So that's why those companies have benefited quite significantly since the Brexit vote, whereas those that have been more domestically focused have not benefited quite as much, or anywhere near as much, I should say. So that is really what we're looking for tomorrow. We want to see exactly what it is that Mark Carney and Bank of England are expecting over the course of this year and potentially next, whether their forecasts have changed, how much they've changed, and what that could mean for interest rates going forward. Now let's take a look at some charts. I've got 4 charts lined up for you, 3 sterling, 1 FTSE. First is the pound against the dollar, and as you can see, the most recent momentum has been to the upside. We pulled back to around these 120s at one stage, and since then we have seen it rallying higher. This has been a combination, I think, of the fact that the UK data has been positive, of the fact that the Supreme Court ruling ruled against the government, which means that they have to pass, which means that the triggering of Article 50 has to be agreed through Parliament, and effectively that just gives leverage to the people who didn't want Brexit, and also to people who want to have more say on the Brexit vote. And what that means is it means that it reduces, I guess, the chance of a harder Brexit, because MPs have to vote on the triggering of Article 50, and therefore are likely to vote, and I think Theresa May's already said this, on the actual deal as well. So the reduction in the risk of a very hard Brexit has been sterling positive, and also by the fact that Donald Trump and his administration have been trying to talk down the dollar recently. So we've seen it go up to around these 126.50s. It initially ran into resistance. Now we're seeing it trade at these levels again. You can see the moving average band, the 55.89, as it has previously, playing a role as support on this occasion. It was resistance previously. We are seeing it test these highs around 126.50. If we break through there, I think we could be looking at around these 128s, and I think that's your next key level as far as sterling is concerned versus the dollar. I'll be surprised if we break above there, because really beyond there we are looking at around maybe these 132, 131.50, 132.50, 132.75. That's your 200 and 233 day simple moving average band, or even slightly beyond there around 133.50s. I think this is a big jump higher, and therefore psychologically speaking, at least, a break above these 128 to 128.50s would be quite substantial. to the downside, I should say, sorry, then you've got support possibly coming in around these 124s to 124.40s. Again, that moving average band, which provided support yesterday, and then which meant that yesterday's becomes a new support level, but it's also a prior level of resistance as well. And a breakthrough there could open up a move potentially back towards around these 122.50s. Beware if we do see a pull off these 126.50s as well, the potential formation of a double top here, although of course we're still far away from that. The euro against the pound, we are starting to head lower once again. Now this is a tough one, I think, right now, because the euro has actually been performing relatively well recently, and I think this comes from the fact that we saw the ECB actually reduced its asset purchases at the end of last year, back to 60 billion from March. And I think this has been seen as a sign that we are seeing a rise in inflation, albeit again, this is temporary rise in inflation because rising commodity prices. This is not organic. This is not driven by better economic growth. This is not, or primarily, this is not driven by tighter labour markets because unemployment is still very high in most of the region. This is, I think this is quite clearly driven by temporary measures, but the ECB is responding because I think it's coming under pressure from the likes of Germany, where we are seeing inflation at or around the ECB's target, where there are much tighter labour markets. And I think that the pressure here with inflation rising could build to do another reduction in asset purchases as well, or a continuation of the tapering if you believe what most people are saying and ignore Mario Draghi repeatedly trying to convince us this isn't tapering when it quite clearly would appear to be. So the euro has actually been performing quite well because of that, because this is effectively like a tightening of monetary policy. But the pound is actually performing slightly better. And what we've seen is while we got to around these 88, 89-ish levels, we have started to trade lower again. We found resistance once again around these 86.40s, which is where we found resistance on the way up. We found support once again around these 84.75s, where we found support previously. If we break through those 84.75, you may look at this and think, well, that looks a bit like a head and shoulders to me, and that is understandable. The problem I have with this is it's not really in an uptrend. This is in an uptrend, shoulder, head, shoulder, but this little one is on a minor uptrend, so I find it too hard. I find it a little difficult to buy into this as a head and shoulders at this stage. However, a break below this could be quite a significant bearish signal, at which point these 83s to 84s becomes crucial, because not only is this a prior zone of support and potentially a head and shoulders neckline break, but you've also got this 200 and 233 day simple moving average here as well. So I struggle to see a break of this given that the euro is also performing quite well, but I think this is going to be a very, very crucial area of support for this pair. Should we see the pound sterling strengthen following the Super Thursday tomorrow? Sterling is also starting to perform well once again against the Japanese yen. The yen, of course, we're still seeing the Bank of Japan undergo its own large stimulus program. It's committed to keeping the 10-year yield close to or around 0%. We did see the pound fall back when it ran into a little bit of weakness, and we were seeing that safe haven buying. But we are seeing the pound, or sterling, rally once again since really the middle of January. We saw that the 55-89 periods simple moving average band providing support here, as well as the bottom of the cloud. We've broken above the 200 and 233 day moving average band, and now found support on the bottom of it. So this is looking quite bullish right now. If we can see a break through these 144.50s, then we could be looking at a move back towards these 148s potentially. 144.80 to 145.40 around there. A breakthrough there, we could be looking at a move back towards these 148.50s. Whereas if we fail at these levels and move back below these 140.40s, then we could be looking at, well, the key level for me then becomes around this 137.50 really. This is the bottom of the Ichimoku cloud. It's also the bottom of the moving average band here, the 55.89. Now previous support comes at around 136.50 just below here, but I think a break of the Ichimoku cloud and moving average band is extremely significant. Wrapping it up with the FTSE now, like I say, we've got that inverse relationship. When the pound gets stronger, the FTSE seems to pull off, and that's exactly what we've really seen here over the course of the past couple of weeks. It pulled off these record highs around 73.58. You can see that that's a record high if we just keep scrolling back. What we've come back to, though, is a very interesting support level, because this is a prior area of resistance on the way up, just above 7100, call it 7125. Just below here, we've got 7100, which is a psychological support level, 38.2% retracement of the move from the December lows to the January highs. If we break below here, then I think 7020 becomes quite important. 7,000 to 7020, that's a 50% retracement of that same move, but you've also got the moving average band coming in here as well, and once again, quite an important psychological level. Now, it looks like momentum is still to the downside in this, which doesn't surprise, given that the momentum still seems to be with the pound upside. But this, if we do break 7100, 7,000 to 7020 becomes very, very important for me, and a break below here could prove to be quite a bearish signal. Well, that's all we've got time for today, guys. I hope you found that really useful. As always, please leave comments below. Any feedback is always welcome. We'll also be bringing you another video tomorrow looking ahead to the US jobs report. And aside from that, I hope everything is going very well, and I'll speak to you all very soon. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.